The median retirement savings for men between 55 and 64 is $185,000. That is Federal Reserve data, their own survey of consumer finances. $185,000. The Bureau of Labor Statistics says the average retiree spends $59,616 per year. Do that math, and the nest egg lasts 3 years. Maybe 3.5 if you cancel cable and give up the gym. But here is the part the retirement planning magazines don't put on the cover. The savings shortfall isn't what destroys most retirements. What destroys most retirements is what men do to fix the shortfall. They claim Social Security at 62 and lock in a 30% permanent benefit reduction for the rest of their lives. They retire before 65 and discover a 3-year healthcare gap with premiums over $1,000 a month that nobody modeled into the plan. They go all conservative with bonds to be safe and watch inflation quietly eat a 25-year retirement. They go through a gray divorce at 63 and lose 21% of their standard of living permanently, according to research published in the Journals of Gerontology. And the entire time, they thought the hard part was accumulating the money. They thought crossing 60 was the finish line. It isn't. It's where the rules change entirely. And most people don't find out until they're already losing. This video covers 11 specific financial traps men fall into after 60. Not the vague ones you've heard before. The ones with real dollar amounts, real mechanisms, and real psychological triggers. Because here's what I've found. After 10 plus years running businesses and managing my own money, every major financial mistake in this phase of life is not actually a math problem. It's a psychology problem dressed up as a math problem. And that distinction matters enormously for how you solve it. Before I get into trap 1, there's a framework I need to give you that explains why all 11 of these traps exist in the same decade of life. I call it the 2 modes of money. During the accumulation phase, roughly ages 20 to 60, your job is to keep money in. Contribution, compounding, patience. The rules are forgiving. You get another paycheck next month. During the distribution phase, everything after 60, the rules reverse completely. Withdrawing at the wrong time costs you. Being patient with the wrong account costs you. Trusting the institutions that were built for accumulation to guide you through distribution costs you most of all. Every trap in this video exists at that exact fault line. Someone applied an accumulation phase instinct in a distribution phase world. Think of your retirement savings as a tank you spent 40 years filling. Every paycheck, every employer match, every bull market year, more water in the tank. After 60, someone flips the faucet. The water starts flowing out instead of in. And the tank has 11 holes in it that weren't visible during the filling phase. Some of the holes are small, some of them drain the entire tank in 3 years. The goal of this video is to show you where each hole is, and more importantly, which ones you can actually patch. I'm going to follow a character through several of these traps, not because he's a real person, but because the sequence of decisions I'm about to describe is statistically ordinary. His name is Robert. Project manager, 61 years old, Virginia. Built a solid career, had a plan. Remember him. In a few minutes, I'm going to show you the trap that turns an entire decade of good financial behavior into a tax bill you didn't see coming. But first, here's why the foundation collapses before most men even realize the game has changed. According to the Employee Benefit Research Institute's survey of 3,600 retirees between ages 62 and 75, 58% of respondents were forced into early retirement, not by choice, by a health problem, a disability, a layoff, a corporate restructuring. 58%. More than half of the men who retired didn't retire. They were retired at them. Robert's company announces a restructuring. He gets 14 weeks of severance and an outplacement service. He applies for project management roles. He gets interviews. He doesn't get offers. Not because he's incompetent, he isn't, but because the unspoken math in most hiring decisions for technical leadership roles doesn't favor someone who is 61. After 8 months, he's burning through savings. He needs income. And this is where Trap 2 opens its jaws. In the first half of fiscal year 2025, Social Security retirement claims were up more than 276,000 from the same period in 2024, per the Social Security Administration's own data. From January through July of 2025, More than 2.3 million people filed for benefits, up 16% year over year, according to AARP, citing Urban Institute's analysis of SSA filing data. Some of this is demographic, but a significant portion is fear. Acting Social Security Commissioner Leland Dudek noted publicly that fear of insolvency was driving some of the early claims. People convinced Social Security is about to disappear, so they rush to grab it while it exists. Here's the math on that fear. The combined Social Security trust funds are projected to be depleted by 2034, per the SSA trustees' own report. But even then, payroll tax revenue would continue to fund approximately 77% of scheduled benefits. The program trims. It doesn't vanish. But the fear does something specific and financially catastrophic. It causes higher earners, people with the most flexibility, to wait to file at 62 at unusual rates per Urban Institute analysis. Claiming Social Security at 62 locks in a 30% permanent reduction compared to claiming at full retirement age of 67. In December of 2025, the average monthly payment for a new claimant at 62 was $1,335. The average benefit for new claimants at 67 was approximately $2,521. That is a $1,186 monthly gap, permanent for life. If Robert lives to 85, a reasonable planning assumption for a man in good health at 62, he will collect a total of roughly $425,000 by claiming at 62. If he waits until 67 and uses his savings to bridge the gap, he collects over $547,000 in lifetime benefits. That's more than $120,000 in additional income for the same Social Security record, just by waiting. Robert doesn't run this analysis. He claims at 62, he thinks he's being strategic, he's being scared. That's the second hole in the tank. Now here's what almost nobody models correctly in the early retirement budget. Medicare doesn't start until 65. If you retire before 65 or get pushed out before 65, which happens to 58% of people, you have a gap. And filling that gap in 2026 is significantly more expensive than most financial plans account for. According to Smart Assets analysis from March 2026, the estimated average monthly benchmark premium on the ACA marketplace for a 62-year-old is approximately $1,072 per person. By 63, it climbs to $1,102. By 64, $1,120 per month. That's over $12,900 per year just in premiums, before deductibles, before copays, before a single prescription bottle. And here's the twist that landed specifically in 2026 that received far too little attention. The enhanced ACA subsidies that had made marketplace coverage manageable for 4 years expired at the end of 2025. The subsidy cliff is back. If your modified adjusted gross income exceeds approximately $62,600 as a single person, you lose all marketplace subsidies, all of them. If Robert is drawing down his traditional IRA to cover living expenses, which counts as taxable income, he may land just over that cliff without ever planning to. The result? $13,000 a year to stay insured. Over 3 years before Medicare starts, that's $39,000. Nearly his entire liquid savings consumed by staying covered. Fidelity's 2025 retiree healthcare cost estimate put the lifetime number at $172,500 for healthcare and medical expenses for the average 65-year-old, not including long-term care. Long-term care, which nearly 70% of Americans who reach 65 will need in some form per the US. Department of Health and Human Services carries a national average cost of $112,420 per year for a nursing home semi-private room as of 2024. The average duration of care needed is approximately 33 months. Stack those numbers and you have over $234,000 in potential long-term care costs for an event most retirement plans budget exactly $0 for. That's the third hole. By the way, if this level of granular financial analysis is useful to you, hit subscribe. YouTube's algorithm may genuinely never show you my videos again if you don't, and there is more of this to come. Now let's talk about the trap that most men statistically don't see coming because it doesn't present as a financial event at all. While the overall US divorce rate has declined for decades, the divorce rate for adults 65 and older has roughly tripled since 1990, according to Bowling Green State University research published in the Journals of Gerontology. Absolute numbers of gray divorces among those 50 and older increased by over 5% between 2015 and 2025, while every younger age group saw declines. The Allianz Life 2025 annual retirement study found that 56% of married Americans say a divorce would derail their financial retirement strategy. Among boomers specifically, 35% say the same thing. Here is what gray divorce actually does to a man's balance sheet. The Journals of Gerontology research found that men see their standard of living decline by 21% following a gray divorce. Statistical data shows that those divorcing after 60 lose a median of $198,300 in assets. And unlike younger divorcing adults, this group never fully financially recovers. Young adults who divorce financially recover within about 2.3 years on average. Men who divorce after 60, the data says they don't get back. The Social Security angle is its own quiet penalty. If the marriage lasted fewer than 10 years, no spousal benefits are available. If it lasted 10 or more years, spousal benefits exist at 50% of the ex-spouse's record, compared to 100% for a widow or widower. The system that was architecturally designed, assuming couples stay together until death, imposes a permanent financial haircut on every late-life divorce. Older man on the phone to his accountant, so after the divorce, what exactly is left? Accountant, long pause. Which account are we talking about? Man, all of them. Another pause. Yes, that's the fourth hole. And unlike the healthcare gap, it doesn't show up in a planning document. It arrives as a conversation. And by the time the financial damage is visible, the decisions that caused it were made years earlier. Here's the honest part I want to state clearly before the next section. Knowing these numbers, the Social Security gap, the healthcare cliff, the gray divorce math, and building an actual system around them before you're 60 are two completely different things. Most of the retirement planning tools that exist are too generic and too optimistic about their baseline assumptions to be genuinely useful. I put together something called the Exit Code. It's a digital book, 8 chapters built entirely on 50 years of actual retirement data. No filler that addresses 2 things directly relevant to what we just covered. First, what I call the $14,000 invisible bill, the insurance gap that financially wrecks people who retire before 65. Second, the 58% rule named after that EBRI statistic and the specific buffer strategy you need when your retirement exit isn't on your own timeline. The book also covers the 4% trap and a dynamic withdrawal method that adapts to what markets actually do instead of assuming they cooperate with your plan. It costs less than a restaurant meal for 2. The link is in the description below. Now, here's the trap that makes identical portfolios produce completely different retirements. And it's one that requires you to sit with a counterintuitive idea for a moment. You think the biggest risk in retirement is a market crash. It's not. The biggest risk is a market crash at the wrong time. There's a difference. And that difference is worth $665,000, according to WealthView's analysis of 2 retirees with identical average returns over 20 years, but different return sequences. Here's the purest version of the story. 2 men, both retire with $1 million. Both withdraw $50,000 per year. Both average 7% annually over 20 years. The only difference is the order their returns arrive. Man A gets strong early returns and a major crash late. After 20 years, his portfolio exceeds $1 million despite 2 decades of withdrawals. Man B gets the crash first. Within 5 years, his portfolio is so depleted that even strong subsequent returns can't bring it back. He runs out of money in year 22. Same fund, same discipline, same average return, different sequence. According to Schwab's research, a 15% drop in the early years of a retirement portfolio combined with ongoing withdrawals causes far earlier portfolio depletion than the exact same drop later in retirement. The research from Bullseye Retirement Planning puts it in stark terms. Poor investment returns in the first 5 to 10 years can permanently cripple a portfolio, even if returns are strong later. The combination of withdrawals plus losses creates a hole that future gains cannot fill, because you've already sold shares at depressed prices. Those shares are gone. Someone who retired in January of 2000, heading straight into the dot-com crash, with the 2008 financial crisis arriving less than a decade later, had a permanently impaired portfolio, even after markets eventually recovered. Compare that to someone who retired in January 1982, right at the start of one of the longest bull runs in American history. Same strategy, completely different life. The retirement date itself is a source of risk you cannot predict and cannot control. And here's the behavioral trap that makes it worse. JP. Morgan research found that 14% of near retirees over 59.5 withdrew an average of 30% of retirement plan assets during volatile years. They panic sold during the crash. The shares were gone. They couldn't participate in the recovery. That panic wasn't greed, it was fear. And fear in the distribution phase is twice as expensive as it was during accumulation, because there are no more paychecks to dollar cost average back in. You think the problem is the crash. The actual problem is how your portfolio is structured going into the crash. A 2-year cash buffer, 1 to 2 years of living expenses held outside your investment portfolio in a high-yield savings or money market account means you are never a forced seller during a down market. You spend from the buffer. Your investments recover at their own pace. You don't crystallize the loss. According to research from Schwab's Center for Financial Research, this structural adjustment significantly extends portfolio longevity through volatile early retirement periods. That's the fifth hole, pluggable. But only if you build the buffer before you need it, which leads directly to the sixth trap, the misapplication of the most cited number in retirement planning, the 4% rule. William Bengen formalized this concept in a 1994 paper in the Journal of Financial Planning. The logic: withdraw 4% of your portfolio value in year 1, adjust for inflation each year after, and historical data suggests your portfolio survives 30 years. That is what the research showed under specific historical conditions. Here's what most people do with it. They treat it as a fixed law. They withdraw 4% of the original balance no matter what the market does, including in the years when the market has just dropped 30%. Research from dynamic withdrawal frameworks, specifically the Guyton-Klinger guardrail approach, shows that flexible strategies improve portfolio survival rates by 10 to 20 percentage points compared to rigid, fixed withdrawals. The difference between surviving a 30-year retirement and running out of money in year 22 is not the savings amount. It's whether you treat 4% as a ceiling you stay under in bad years or a floor you must always hit. You think the problem is how much you saved. The actual problem is how you take money out. The habits that worked during accumulation maximum contributions, consistent amounts, fixed percentages, produced the worst possible outcomes in distribution. That's the sixth hole. Stay with me for this next one, because it specifically targets men who did everything right. The RMD Tax Bomb. If you spent 30 years maximizing a traditional 401k or IRA, every dollar in that account has never been taxed. It grew tax deferred, which felt like an advantage, and it was during accumulation. Starting at age 73, however, the Internal Revenue Service requires you to begin taking required minimum distributions from traditional IRAs and 401ks. These distributions are taxed as ordinary income. Not capital gains rates, your full marginal income tax rate. Here's what that looks like in practice. If your traditional IRA is worth $1 million at 73, the IRS requires a withdrawal of approximately $37,700 that year, based on the Uniform Lifetime Table Divisor of 26.5 for age 73. That RMD gets added to your Social Security income, any pension, any other investment earnings. And many retirees discover they are now in the same tax bracket they spent their entire career trying to escape. If your account grew to $2 million, which is a good thing, not a mistake, your mandatory distribution exceeds $75,000 per year in fully taxable income. Because the S&P 500 returned 23.3% in 2024, many retirees' RMD obligations in 2025 were significantly higher than projected. The bull market you celebrated in December became the IRS obligation in April. And there's a second layer most people don't connect. Medicare's income-related monthly adjustment amount, IRMA, uses your modified adjusted gross income from 2 years prior to set your premiums. In 2026, the standard Part B premium is $202.90 per month. If your income crossed specific thresholds 2 years ago, that premium climbs to $689.90 per month per person. Same Medicare coverage. 3 times the cost because your RMD pushed your income above the threshold 2 years earlier. The solution, Roth conversions, during the years between retirement and age 73 exists and is well documented. Converting pre-tax IRA money to Roth accounts during the window when your income is lower creates tax-free accounts with no RMDs, no IRMAA surcharges on the converted balance, and tax-free inheritance for your heirs. Most men who know about this don't execute it because paying taxes today feels worse than paying them later. Loss aversion, the psychological tendency to feel the pain of a payment now more intensely than you feel the future benefit, stops people from doing the mathematically obvious thing. That's the 7th hole. Entirely preventable, rarely prevented. Now, let me tell you about something the financial industry is not in the habit of including in net worth statements. In 2025, Americans 60 and older reported losses of $7.7 billion to internet-based fraud, a 60% increase from the prior year, according to the FBI's 2025 IC3 annual report. Investment scams caused the most financial damage among all fraud types. In 2024, victims in their 60s reported $1.18 billion in total fraud losses versus $810 million for victims in their 30s, even though roughly the same number of fraud reports were filed by both groups. Older adults lose more per incident because they have more to lose. The FTC documented cases of people over 60 emptying bank accounts and clearing out 401k plans. These were not isolated incidents. The agency noted a more than 4-fold increase since 2020 in reports from older adults who lost $10,000 or more to impersonation scammers and combined losses reported by those who lost more than one. $100,000 increased 8-fold from 2020 to 2024, going from $55 million to $445 million. The mechanism is not stupidity, it is trust, built deliberately over weeks and months by someone who speaks the language of finance fluently. They research their target. They arrive with specificity. They target financial confidence, not financial ignorance. The more you believe you can spot a bad deal, the more vulnerable you may be to a sophisticated one. A man with 30 years of corporate experience who managed his own portfolio through 2 major market crashes and negotiated his own severance package, once handed $80,000 to a person he met on LinkedIn who claimed to be a senior analyst at a major asset management firm. The analyst was operating from a different continent. These are patterns documented in real FTC and FBI reports, not edge cases, but a growing category of financial crime specifically designed for this demographic. The phone rings. This is a representative from your bank's fraud prevention department. We've detected unusual activity. Long pause. How did you find us? Sir, the system flagged your account. We need to move your funds to a secure holding account immediately. My financial advisor told me never to move money on an unsolicited call. Longer pause. The person on the other end sounds genuinely hurt. Of course, you're absolutely right to be cautious. That's exactly what a careful investor should say. He moved the money. This is the 8th hole. And unlike the others, it is not reversible. The 9th trap is the one you may be paying for right now, even if you think you have a good advisor. The typical financial advisor charges between 1 and 1.5% of assets under management per year. On a $300,000 portfolio, 1% annually is $3,000, which sounds reasonable. But 1% per year on a $300,000 portfolio, compounded over 30 years, doesn't cost $90,000 in total fees. It costs approximately $170,000 in lost compounding. Not fees paid, compounding you never collected. The money that never earned a return on itself because it went elsewhere. This is not a blanket argument against advisors. Fee-only fiduciaries who charge flat annual fees rather than a percentage of assets represent a different model entirely. The specific problem with the percentage of asset structure is its incentive architecture. The advisor earns more when your balance is higher, not necessarily when your net returns are better. Think carefully about whose interests that structure optimizes for. The 10th trap, going too conservative and quietly losing to inflation over what may be a 25 to 30-year retirement. A man who retires at 62 in good health may live to 87. That's 25 years of retirement. At 2% average annual inflation, his purchasing power in year 25 is roughly 60% of what it was in year 1. A portfolio entirely in cash, CDs, and short-term bonds is likely to underperform inflation after taxes over that time horizon. The account balance looks stable. What the account can actually buy keeps declining, slowly, invisibly, until the numbers that look safe in year 1 no longer pay for the life they were supposed to fund. The 11th trap, the long-term care wildcard that most retirement plans account for with exactly $0. Nearly 70% of Americans who reach 65 will need some form of paid long-term care per the U.S. Department of Health and Human Services. The national average cost for a nursing home semi-private room in 2024 was $112,420 per year, according to the Federal Long-Term Care Insurance Program. The average duration of care needed is approximately 33 months. 25 months at that average rate costs $234,200, more than the entire median retirement savings for men between 55 and 64. One medical event, the nest egg gone. Medicare covers essentially none of it. Traditional health insurance covers none of it. Long-term care insurance exists, but the window to get meaningful coverage at a non-prohibitive premium is in your 50s, before any health conditions that would make you uninsurable. Here's where Robert ends up, by the way. He claims Social Security at 62 out of fear. He spent his first 3 years of retirement paying over $13,000 annually in marketplace premiums without understanding the subsidy cliff. He went through a divorce at 66 that neither he nor anyone in his life saw coming and split a substantially depleted 401k in the process. His remaining portfolio faced a rough 2-year stretch in which he sold some positions out of anxiety. He now has an advisor charging 1.2% on what's left. His RMDs start in 7 years. He has no long-term care insurance. He made no exotic mistakes. He made no reckless bets. He just didn't know where the holes were until the water was already flowing out. Let me make this concrete with one more specific scenario. A man, call him Michael, civil engineer, Midwest, 62 years old, laid off in a company restructuring 8 months ago. He has $480,000 in a traditional 401k, a house worth $300,000, $42,000 in a regular savings account. His projected Social Security benefit at 67 is $2,200 per month. At 62, it drops to approximately $1,540 per month. He's leaning toward claiming at 62 because he needs income and he's nervous. Here's what the math actually says. If Michael claims at 62 and lives to 85, 23 years of benefits, he collects a total of approximately $425,640 in lifetime Social Security payments. If he waits until 67 and uses his savings to bridge the 5-year gap, he collects approximately $576,000 over 18 years. Waiting is worth roughly $150,000 in lifetime benefits, and he has the savings to do it. He doesn't know that. He claims at 62, he also hasn't run the healthcare numbers. He's 62 with no employer coverage and 3 years before Medicare. In 2026, his ACA premiums without subsidies, because his IRA withdrawals push his income over the threshold, run approximately $12,000 to $13,000 per year. Over 3 years before Medicare starts, that's $36,000 to $39,000, almost his entire savings account spent on staying insured. His 401k is in the market, he's drawing from it. If the market has a bad first 2 years of his retirement, historically about a 1 in 4 probability, he's selling into a down market with no buffer and no income floor from employment. Sequence risk isn't theoretical for Michael. It's the structural reality of his specific situation right now. Add one variable. His marriage of 28 years has been strained since the layoff. The financial stress has surfaced a tension that was always underneath. If Michael's marriage fractures in year 2 of his retirement, he splits the 401k and potentially the house. He's now 65, single, with a depleted account, a reduced Social Security benefit, permanently locked in at 62, no healthcare subsidy, mounting RMD obligations arriving in 8 years, and a portfolio that's been selling into volatility. None of this required bad luck. These are ordinary decisions colliding with ordinary life events. The outcome is financial fragility at precisely the moment when nothing can be corrected. Let me close with 3 specific, non-generic takeaways calibrated exactly to what we covered today. First, if you are between 60 and 67, run your actual Social Security break-even analysis before you make any claiming decision. Not a general article, the Social Security Administration's own calculator at ssa.gov using your specific earnings record. For most men in good health, with any financial flexibility to wait, claiming before full retirement age is not strategic, it's expensive. For most men, the break-even point where waiting pays off cumulatively is in the late 70s. If your family health history and current health suggest you'll get there, waiting is almost always the better math. Second, if more than 2/3 of your retirement savings are in traditional pre-tax accounts, have a conversation with a tax professional, not your investment advisor, specifically about Roth conversion strategy before you turn 73. The years between retirement and the RMD age are the lowest income window most people will have in adulthood. It is the single best opportunity to move money from fully taxable to tax-free accounts that you will ever have. Most men let that window close by accident and spend the following 20 years paying for it in taxes, IRMA surcharges, and reduced estate value. Third, build a cash buffer of 1 to 2 years of living expenses outside your investment portfolio, not inside a brokerage account before you retire. In a high-yield savings or money market account, that buffer is the structural difference between someone who holds through a market downturn and someone who panic sells at the bottom. The entire sequence of returns problem is manageable with this one adjustment, and it costs nothing to implement other than the discipline to do it before you need it. Lazy investing built more fortune than crypto memes. And if you're sitting there thinking any of this sounds too simple to actually cost that much money, remember that Robert claimed Social Security at 62 because he was scared and never ran the break-even. Math. The traps aren't complex. The psychology is. And the first thing the financial industry learned is that a scared man in his 60s with real assets is far easier to manage and far more profitable to manage than an informed